Hi, I'm Allan Madan, and today we're going to talk about the recent changes to Canada's capital gains tax laws. If you're a Canadian investor, business owner, or someone who owns property or stocks, the new capital gains tax changes starting June 25th, 2024 could significantly impact your finances. Knowing how these changes work and implementing smart strategies is key to minimizing your tax burden. If you've been hearing about the 2024 budget and the increased capital gains tax rates, don't worry. In this video, I'll break it all down in a way that's easy to understand. We'll talk about what's changed, how it might affect you, and what strategies you can use to minimize your tax burden. What are the changes? Starting June 5th, 2024, the Canadian government increased the capital gains inclusion rate. For individuals, the first $250,000 of capital gains in any given year is taxed at the old inclusion rate, 50%. But if your capital gains exceed $250,000, the new inclusion rate jumps. Now, 2/3 or 67% of those additional gains will be taxed. There's also a change in the Lifetime Capital Gains Exemption from $1 million to $1,250,000, which is good news for business owners. For corporations and trusts, it's a straight increase in the inclusion rate from 1/2 to 2/3 on all capital gains. The tax rate on capital gains has also increased in each province, which you can see in this chart. The government says this change targets the ultra wealthy, but in reality, many Canadians will be affected, especially individuals selling real estate, since property is rarely listed lower than $250,000 these days. Now, you might be wondering, why should we care about capital gains tax rates? A favorable capital gains tax encourages people to sell assets and reinvest in the economy. Entrepreneurs work hard to build businesses, and if they're heavily taxed on their gains, they might be less likely to take risks, innovate, or sell assets. And it's not just entrepreneurs. Young Canadians inheriting second properties or other assets from baby boomers will also be impacted. A reasonable capital gains tax can help them get ahead financially, giving them the ability to reinvest and build wealth. Impacts on individuals. Let's look at some examples to make it clearer. Example 1, sale of rental property. Let's say Anne bought a rental property for $200,000 and sold it 5 years later for $600,000. Her capital gain is $400,000 and her marginal tax rate is 53%. Under the new rules, the first $250,000 will be subject to the old inclusion rate, 50%. The remaining $150,000 will be subject to the new inclusion rate of 66.7%. In total, Anne will pay $119,250 in taxes. The tax changes mean that the effective rate has increased on gains over $250,000 from 26.5% to 35.7%, which is a 9.2% increase. Let's look at a business example. Bob owns ABC Inc., a corporation in the garment industry based in Ontario. Suppose ABC Inc. sold its warehouse for a profit of $100,000. ABC's corporate tax rate is 50% on passive income, including capital gains. Under the old rules, $100,000 of the gain is subject to the 50% inclusion rate, and ABC Inc. will pay a corporate tax on $50,000 of taxable income. However, under the new rules, the inclusion rate increases to 66.7%, and ABC Inc. will pay corporate tax on $66,700 of taxable income. ABC Inc. pays a capital gains tax of $25,000 under the old rules, which equals an effective tax rate of 25%. However, ABC Inc. pays a capital gains tax of $33,500 under the new rules, which equals an effective tax rate of 33.34%. This represents more than an 8% tax increase for ABC Inc. Strategies to minimize capital gains tax. Given the tax law changes, here are 4 key strategies to help you reduce your capital gains tax burden. First, sell assets gradually. By spreading the sale of assets over several years, you can keep your annual capital gains below the $250,000 threshold. This way, you'll avoid the higher inclusion rate. Next, consider setting up a family trust. A trust can help you split capital gains among family members, letting each person take advantage of their own $250,000 threshold. This reduces the overall tax liability. If you're a business owner, it may be more advantageous to purchase stocks or other investments personally rather than through the business. Before you do this, you'll need to consider the overall financial goals of your business versus your personal wealth goals. Finally, don't forget to apply your capital losses. If you've experienced capital losses in the past or expect them in the future, use them to offset capital gains, especially since capital losses can be carried forward indefinitely. With these strategies, you can minimize the impact of the higher capital gains tax rate and optimize your financial planning under the new laws. If you have any questions about how these changes affect you, or if you need help with your tax strategy, feel free to reach out to our team. We're here to help, and you can find our contact information in the description below. Thanks for watching, and don't forget to like and subscribe for more tax tips and financial advice.